In this video, I'm going to go over the pyramid of risk and reward assignment. For this assignment, you were asked to evaluate various places where you could put your money and assign rankings according to risk and reward. The correct rankings are highlighted. If you were going to put your money under your mattress, the money could be stolen, presenting a financial risk. You have access to the money anytime you want, but there is no rate of return. If there is inflation, the real rate of return would be negative. A savings account is highly liquid, meaning you can get your money at any time. There's little risk of losing your money because the account is insured by the FDIC. However, the interest rates are low, and those interest rates may not keep up with inflation. A certificate of deposit is also insured, so there is low risk. These accounts pay a higher rate of interest than a regular savings account, but you must hold the money in the account for some specific period of time. If you take your money out, then you could be charged a penalty. If you put your money in a longer term certificate of deposit, then you have more risk associated with the interest rate because that interest rate is fixed. U.S. government securities include savings bonds and treasury securities sold by the federal government. Basically, you're loaning the federal government money. There's very little financial risk. There is market risk because investors are locked into a stated interest rate. If you take the money out before maturity, a penalty may apply. Interest rates are higher than a regular savings account. Money market mutual funds are managed by a professional with a license to sell investments. There's little market risk, but they tend to have lower rates of return. They may not keep up with inflation. They are liquid and provide a higher earnings than a regular savings account. Corporate bonds are loans to corporations as a way for a company to raise money for growth or expansion. The maturity dates are generally at least a year. The bond has a stated maturity date and a stated rate of interest. The value of the bond is based on the company issuing it, so there is financial and liquidity risk. There's also inflation risk because the interest rate is set. Stocks have the potential for high rewards but face market risk. Many stocks carry significant financial risk. That depends on the stock itself. For example, blue chip stocks are listed on the Dow, and those are stocks that are issued by very large, financially secure companies. On the other hand, speculative stocks are high risk stocks in emerging companies or other risky business ventures. Stock mutual funds offer diversity. They can be bought and sold daily, so they are very liquid. They do, however, expose the investor to market risk.